Now let's see the second method of estimating allowance for doubtful accounts. And the second method is based on the accounts receivable, and we sometimes refer to it as the balance sheet approach. So the analysis of receivable method is based on the assumption that the longer an account receivable is outstanding, the less likely it is that it will be collected. And that's true. If something gets to be too old, it's very difficult to be able to collect it sometimes. So there are a few steps that we have to go through this. So the analysis applies these steps, and let's see these steps quickly and just briefly to understand how it works. So the first step is the due date of each account receivable is determined. Then the number of days each account is past due is determined. This is the number of days between the due date of the account and the date of the analysis. Then in step number 3, each account is placed in an age class according to its day past due, like separate categories like 1 to 30 days, 31 to 60 days past due, 61 to 90, and so on. Then in step number 4, the totals for each age class are determined. In step number 5, the total for each age class is multiplied by an estimated percentage of uncollectible accounts for that class. And by the way, the percentage keeps increasing as the past due period gets to be longer or larger. And then in the last step, the estimated total of uncollectible accounts is determined as the sum of the uncollectible accounts for each age class. So this is the process, and we typically use an Excel sheet to be able to apply this kind of analysis. So the preceding steps are then summarized in an aging schedule, and this overall process is called aging the receivables. So let's see like a part of an Excel sheet that explains this. So you can see here in the first column we have the customer name, and it's truncated here. You can see that they cut the customers between 7 to 21. Then we have a column for balance, column for not past due, and this means that these values are still current. And then 1 to 30, 31 to 60, 61 to 90, and so on until over 365 days. So these are the days past due. This column here, this is not past due. So for example, we have customer name Ashby and Company. They have a balance of $1,500. These $1,500, they're actually past due by 31 to 60 days. It could be something around maybe 55 days, 40 days, something in this range. So what we do is that we put each balance for each customer. Of course, we have the balance here for a total of $240,000, but we put it in its right spot, whether it's not past due or whether it's past due according to the period. Then we add all these columns. So 240, and then we have all these values here. If we add them up, they should total to 240,000. Then the percent uncollectible, as you can see here, it's like when something is not past due, it's very low percent, 2%. And then when it keeps going older, then something past due by more than 365 days, which is more than a year, is 80%. There's an 80% chance that this amount is not going to be collected. So we take these percentages multiplied by the total for each column, and then we get these values, and that would be the estimate of uncollectible account for each category. Then we add them all together, and that will give us $26,490. So out of the $240,000 balance of accounts receivable, we estimate that $26,490 would be uncollectible. So that's the approach using the aging of receivables schedule. So the sum of the estimated uncollectible accounts is the estimated uncollectible accounts on December 31st. This is the desired adjusted balance for allowance for doubtful accounts. And I think this is a major difference compared to the percentage of sales method or credit sales method. Because here we are looking for the desired adjusted balance, not the adjusted amount or the adjusting amount. So comparing the sum of the estimated uncollectible accounts in the aging schedule with the unadjusted balance of the allowance account determines the amount of adjustment for bad debt expense. So let's see how it works. So for the company that we've been dealing with, which is Extone Company, the unadjusted balance of the allowance account is a credit balance of $32.50. The amount to be added to this balance is therefore $23,240. So let's go back here. You see our desired value is $26,490. we already have a balance of $32.50. So we take the $26,490, which is the desired balance, minus the existing balance, $32.50, and that would be $23,240. So we're going to have an adjusting entry with this value. That's different from the percentage of credit sales method. In the sales method, we just, whatever value we get, we just record it in the adjusting entry. Here we need to get the difference between the desired value and the existing balance. So in our case here, it turned out to be $23,240. We debit the bad debt expense and we credit the allowance for doubtful accounts. So the impact on the T account would be as follows. You can see here that we have the bad debt expense is going to be debited by $23,240. The allowance for doubtful accounts is going to be credited by $23,240. We have an existing $32.50 credit, so that would bring our new balance to $26,490, which is our desired balance. So the amount of the adjusting entry is the amount that will yield an adjusted balance for the allowance for doubtful accounts equal to that estimated by the aging schedule. And in this case, you can see the difference. So let me skip this checkup corner. I'll let you practice it yourself, and we'll do some kind of comparison between the methods. So here we have the percentage of sales method on the top and the analysis of receivable method at the bottom. I like to call the first method the income statement approach because it's based on sales, and sales is an account that appears on the income statement. The other one I like to call it the balance sheet approach because it's based on receivables, and receivables appear on the balance sheet. So you can see here in the percent of sales method, the estimate emphasizes income statement, as I just mentioned. So the bad debt expense adjustment would be recorded as follows. We debit the bad debt expense, $22,500, which was based on the percentage that we have multiplied by our credit sales for the year. And the same value is going to be recorded as the adjusting entry. The adjusted balance is going to be whatever it comes based on the previous balance. In the analysis of receivable method, it's different. We got the $23,240 because our desired value was $26,490. We have an existing balance, so we plugged in the needed amount, which is the adjusted balance. So $23,240, that's the value that are going to be recorded in the bad debt expense. So you see here in the percent of sales method, the arrow was going that way. But in the analysis of receivable method, the arrow is going that way, or in the other way. Now let's see a quick comparison between the direct write-off method and the allowance method. And here we have an example where you can see that we have the records of Hobbs Company for the year ending December 31st. And there are a bunch of transactions, and where you can see here they wrote off an account, they received some cash as a partial payment for an account from one of their customers, and then they also received another amount of cash for an account that has been previously written off, and then they wrote off these balances, and then finally they have the adjusting entry where the company uses the percent of credit sales method, which is the easiest method. Based on past history, the industry average, it's 1/4 of credit sales are expected to be uncollectible. The company recorded $3.4 million of credit sales during the year. So here we have a side-by-side comparison between the direct write-off method and the allowance method. So you see here on March 1st, under the direct write-off method, we debit the bad debt expense and we credit accounts receivable for Sea York. And this is what we record whenever we have a customer who is not paying. So when we decide to write off their account. So in this case, we debit the bad debt expense. In the allowance method, we don't do that. We have to use the allowance for doubtful account. We don't record the bad debt expense. The bad debt expense is only recorded at the time we're doing the adjusting entry at year end, based on an estimate. Then on April 12th, where we have some cash collected, so we have an account from Carrie Bradshaw for $5,500. They paid part of it, but for the remaining part, they couldn't pay. So we debited cash, we debited the bad debt expense, and then the accounts receivable balance was credited. So this is an example for an account that's been partially paid. And then if you compare that to the allowance method, it's almost the same. The only difference, except of using bad debt expense, we use allowance for doubtful accounts. Then on June 22nd, we see here a reversal journal entry for Mr. York here that actually paid off their balance. So in June 22nd, this was previously written off on March 1st, now they're paying. So what we do is that we reversed this this journal entry that happened on March 1st. So we debited accounts receivable and credited the bad debt expense. And then on the 22nd, we collected the cash and we credited the accounts receivable, which is a collection journal entry. Under the allowance method, it's going to be exactly the same. We're going to reverse the March 1st journal entry, but of course we're going to credit allowance for doubtful accounts instead of bad debt expense. But for the other journal entry for the collection of cash, it's going to be exactly the same. Then on September 7th, where we have a bunch of accounts that are going to be written off, you can see that everything is credited and then we debited the bad debt expense. Under the allowance method, everything is credited, but we don't debit the bad debt expense. We use the allowance for doubtful accounts. On December 31st, when we need to do a journal entry, under the direct write-off method, there's no journal entry. There's no adjusting entry, I mean. But for the allowance method, we have to make an adjusting entry. And this adjusting entry is based on the percentage of sales that we had. So we had 3.4 million multiplied by 1.25%, so it's multiplied by 0.0125, and that will give us 42,500. So we debit the bad debt expense and we credit the allowance for doubtful accounts. So this is just an example that shows you side by side the direct write-off method, which is, by the way, not acceptable by GAAP unless you're a very small company and you don't have a lot of accounts receivable. And on the right hand side, we have the allowance method that shows the method that is applied or acceptable by the generally accepted accounting principles. So again, another comparison, just to summarize that, under the bad debt expense, under the direct write-off method, the bad debt expense is recorded when the specific customer account are determined to be uncollectible. Under the allowance method, the bad debt expense is recorded using estimate based on a percent of sales or an analysis of receivables, which is the two methods under the allowance method that we have seen. And by the way, the bad debt expense is only recorded as part of the end of year adjusting entry. Then with the allowance account, of course, under the direct write-off, it doesn't apply because there's no allowance account. Under the allowance method, of course, an allowance account is used. The primary use for direct write-off is small companies and companies with few receivables. For allowance method, it's large companies and those with a large amount of receivables. So let me stop here. In the next video, we're going to be talking about another type of receivable, which is the note receivable.